Imagine waking up one morning, you open your stock app, and suddenly, a stock has jumped 3%. No breaking news, no announcement, no analyst shouting on TV. You ask yourself, why did this move? The truth is, prices are never random, even in silence. They move quietly, powered by forces most beginners can't see. And once you understand these forces, you'll see the market like it's speaking to you, even when no words exist. Let's start with a simple story, one that will reveal why this silent movement happens in the first place. Section 1. The ice cream shop analogy. Imagine a small ice cream shop. Everyday ice cream costs $1. Life is normal. Some people buy, some don't. One day, nothing changes. Same shop, same ice cream, same weather. But suddenly, more people line up. The shopkeeper notices the line growing. He raises the price to $1.05. Not because of news, not because of any announcement, because more people want the ice cream than what is available. This shows the first secret. Prices move because of imbalance. More buyers than sellers, or more sellers than buyers. And just like this ice cream shop, the stock market is a giant marketplace. But here's the twist. In the stock market, people don't queue for ice cream. They queue for beliefs about the future. And because everyone believes differently about the future, prices start moving even without news, which leads us straight into understanding why expectations matter more than headlines. Section 2. Stocks move on expectations, not news. Here's the strange truth. Stocks rarely move because of news. They move because of what people expected before the news. Imagine your friend says, "Tomorrow I will give you $10. You expect it all night. When you receive exactly $10, you feel nothing. If he gives $5, you feel disappointed. If he gives $20, you feel excited. Same event, different reactions. Why? Because expectations were already priced in. The stock market works the same way. Prices move before news, based on what people think will happen. When news finally arrives, often nothing happens. Or sometimes the price moves opposite to what news suggests. But if prices move without news, what actually triggers these moves? That brings us to the invisible battle happening between buyers and sellers every second. Section 3. The invisible war. Between buyers and sellers, every second the market is open, an invisible war rages. Buyers on one side, sellers on the other. Both see the same stock, both have the same information. Yet one wants to buy, another wants to sell. Why? Because they live in different futures. One thinks, this company will grow next year. Another thinks, I've already made enough profit. No news is needed, just different beliefs about what will happen. And when buyers become slightly more aggressive, prices rise. When sellers become slightly desperate, prices fall. And when enough people act on their beliefs, the market doesn't just move, it sometimes moves together, driven by something far more powerful than rational thinking, psychology. Section 4. Fear, greed, and the herd. Humans are not robots. We copy, we follow, we panic together. Imagine a movie theater. Everything is calm. Suddenly, one person runs. Others don't question. They run too. This is herd behavior. In the stock market, it happens every day. A big investor buys quietly. Price rises slightly. Others notice and think, someone knows something. They buy too. Price rises further. Even those who know nothing join in. No news, just fear of missing out. And while emotions push the market, there's another force silently moving prices. The quiet entrance of large investors who leave almost no trace, which is exactly what we'll see next. Section 5. Big players. Move. Quietly. Imagine an elephant entering a swimming pool. It can't jump suddenly. It would make a huge splash. So it enters slowly, step by step. Big investors are like elephants. They control huge sums. If they buy all at once, price spikes instantly. So they buy slowly, quietly, over days or weeks. No headlines, no excitement. Beginners see the stock rising and wonder, why? Answer: someone big is entering the market. And because these big players move carefully, prices drift silently until everyone notices, which is why liquidity becomes the hidden engine behind each move. Section 6. Liquidity, the hidden engine. Think of liquidity like water. A glass of water is easy to drink. A block of ice is not. Some stocks are like water, easy to buy and sell. Some are like ice, hard to move. When money flows into liquid stocks, prices move smoothly. In illiquid stocks, prices jump sharply. No news is needed, just money looking for a place to go. Sometimes money moves simply because it is bored. And as this money flows, human impatience interacts with it, causing moves even when nothing is happening, which brings us to the role of time itself in market movement. Section 7. Time moves. Prices even without events. Sometimes nothing happens, and that itself moves prices. Imagine holding a stock for months, no profit, no excitement. You feel uneasy. You sell, not because of news, but because of impatience. Thousands of people do the same. Price drops. Others see the drop and sell too. And when this impatience repeats over time, it leaves patterns on charts, which leads us to understand why charts reflect human emotion, not news. Charts are emotional. Charts are not magic. They are pictures of human behavior. Fear leaves patterns. Greed leaves patterns. Hope leaves patterns. When many feel confident at the same price, that level becomes strong. When many feel regret, that level becomes weak. Prices bounce, prices break. Not because of news, but because memory lives on charts. And all these forces, expectation, psychology, money flow, combine to show the market's real engine, predictions, not reporting. The market is a prediction machine. The market is not a newspaper. It does not report what happened. It predicts what will happen next. Every price is a prediction, made by millions of minds, smart, emotional, scared, greedy. When predictions change, prices change. News is just one input. Most movement comes from thinking, guessing, and reacting, which is why prices move silently, confusing beginners, but signaling everything to those who understand behavior. Final section, the lesson. Every investor must learn. If you remember one thing, stock prices don't need news to move. They need people, people with expectations, people with emotions, people with money. The market speaks, not in words, but in movement. Once you learn to read these signals, silence becomes louder than any headline. The real secret. It's not predicting news. It's understanding human behavior, the engine behind every price. And once you see this, you will never chase prices blindly again, because every movement already tells its own story.